Good afternoon, it's Adil Fazal here, market analyst for CFDs.com, and bringing you a review of, or attempt to review the aftermath post NFP of the US indices and the biggest reversal in 4 years that took place late Friday afternoon on the US markets, which obviously has sent European shares vertical and obviously has sent the Asian markets higher as well. FX, bond market, everything has been affected, along with commodities to a large extent thus far. So let's see how we can interpret and see what the potential next moves are on the US markets. Okay, so be sure to visit CFDs.com, a leading spread betting and CFD brokerage. Certainly visit the actual webpage www.cfds.com and obviously explore the other services that are on offer. The educational website as well, www.cfds.education. I'm constantly updating and providing analysis and latest charts as well. Okay, so the actual summation of US markets. Okay, so obviously late Friday we rallied quite substantially. European markets are higher, obviously in lead of US markets, and the Chinese are certainly off on holiday, but the Japanese market certainly finished higher as well. Okay, let's start to break this down. Okay, so post NFP, the whole concept of the argument for this rally at present is the fact that the Fed will obviously push back in terms of interest rate hikes and therefore easy monetary policy, weaker dollar, and that obviously helps US equities, okay, and alleviates the concerns of any potential obviously rate hike. Now let's see, that's the theory anyway, okay, and we'll see exactly, so the concept of bad news equals good news is back and the QE trade is in full swing. And now let's see exactly where this market is positioned. Okay, let's start with the S&P 500, or the Russell should I say, the Russell itself. Let's start with the Russell. Looking on a weekly chart of the Russell, you can see clearly here that we've bounced off the 200 MA. This is the IWN. If I bring up the IWM is what I need at present, so bear with me. Okay, here we go. So IWM. Okay, so IWM at present on the weekly chart. I just bring this up. Okay, currently we've obviously put in a bottoming tail and we've certainly bounced quite substantially. Whether that's in the belief that this weak economic data or weak print on numbers, job numbers, etc., is going to be sufficient enough to prevent the Fed from hiking rates and therefore easy monetary policy and therefore buy the stock market. Adding the fact obviously it is potentially into support. And that certainly accumulated together obviously triggered this short squeeze. Now we do have concerns with regards to, so for example, Volkswagen and China, and those two concerns certainly remain. And whether or not this market can sustain a short covering rally and reverse is yet to be confirmed and yet to be seen. We'll see exactly how this market trades this week, and the candle that is confirmed by the end of it. Okay, daily chart of the Russell 2000. Now bear in mind that we did make a lower low, and the next potential low is at 104, and that's your next potential support zone. Looking at your 60-minute chart of the Russell, yes, we have certainly bounced, although we did, like I said, put in a new low. We held the double bottom and the market has bounced quite substantially and quite healthily. Now we are currently testing the 61 to potential 75% fib. Previous support equals resistance on the Russell, and that certainly needs to be respected as well. Okay, so we're going to watch the 61 to 75% level on the Russell, and that will certainly give us a key as to where it wants to trade next. Okay, now let's look at the S&P 500 now and cross-reference that. Okay, so looking at the weekly chart of the S&P, yes, we've put in a bottoming tail. It has bounced off quite substantially, quite healthily. Whether or not it can sustain a move higher is yet to be seen. The red candle certainly remains in control, as you can see here. This red candle that was put in on the 31st of August. Everything is consolidating within that, and obviously we've seen a dip below about 1980 or 1880 twice now. Okay, like I said, China concerns, Brexit concerns, Volkswagen concerns. So there certainly seems to be a lot of biotech concerns. So there certainly seems to be a lot of concerns accumulating. Now we do have the situation in Syria as well, where the Russians now entering the foray. Whether or not that will have an impact in terms of geopolitics, yet to be seen. Okay, daily chart of the S&P 500. Yes, we have bounced quite substantially. Currently trading at the 1968 region. 1968, obviously 1970 is this diagonal trendline resistance. The fib retracement from the pivot high to the pivot low, again, your 61% gives you 1965 and 75% gives you 1983 on the S&P 500. Okay. Now, looking at a 60-minute chart of the S&P 500, we have this inverted head and shoulders formation. So that's certainly a bullish formation from a technical perspective. That needs to be obviously kept in consideration. If this move certainly has legs, then this inverted head and shoulders target needs to hit its level at 2000, which is around here, and your previous pivot high is 2020. Now, there is a gap fill resistance around 1966, 1967, so that certainly will act as resistance in the interim. If that fails, then you have 1978. If that fails, then you have 1988, and then obviously that fails, and you have 2020, and the IHS target at 2000 as well. The 10-minute chart in the S&P 500 certainly has gone astronomical. Again, watch out for 1967. Resistance, gap fill, support. Okay, the next level obviously is 1978. And then there are levels above that. But that 1968 level certainly seems very interesting, and we'll certainly be looking at acting as a resistance for now. Okay, so we can cross-reference this with the Wilshire now. Okay, so you got the Wilshire index. This is your weekly chart first of all. So you've got the bottoming tail, as we can see there, witness here at present. It certainly has put in a bottoming tail. Wilshire 5000 certainly is a good gauge of the overall market strength and depth. Okay, and again, this is actually coming into resistance now, again, given the fact that US futures are up quite substantially and quite healthily. Okay, 60-minute chart of the Wilshire 5000 again is coming into resistance, slammed into the 200 MA for now. We have horizontal resistance, the previous support equals resistance as well. Okay, in the interim. Okay, so then we have the Dow. The Dow is also coming into resistance as well at 16,470. We have gap fill at 16,510 and resistance seen at 16,600. So again, all the indices that I can see at present certainly are coming into resistance. You have biotechs again into the fib resistance. You have semiconductors, which again are leaders of the is a leader of the Nasdaq. Although you do have an inverted head and shoulders formation, we still yet to see whether or not that has legs based on this obviously Fed hike being pushed back. But given the concerns from regards to Germany and European indices, it's going to be very hard for that to continue its thrust higher. The Nasdaq itself, resistance is seen at 4,310. You have gap fill resistance at 4,335, and then you have gap resistance at 4,385, and then obviously above at 4,500. Again, very unlikely to be seen. Why? Because the German DAX is certainly into resistance and remains weak. Given the Volkswagen concerns, etc., and biotech concerns, it's going to be very hard for the markets to certainly reverse powerfully according to that. Okay, I think that's a summation or a good insight into US markets at present. Again, the Dow Transports is coming into resistance as well, and the Dow, which I've showed you as well. So watch the S&P 500 in 1968. Okay, 1966, 1968. That will be your key, given the fact that it's gap fill. And certainly no other catalyst to short squeeze this market higher, especially given the fact that we've had weaker European data this morning. Again, that is a risk-off sentiment from my perspective, a risk-on perspective. Also, given the fact that BOJ is not going to ease it, and no additional easing there either. And given the fact that a weaker dollar equals a higher euro, and that in itself should actually equate to risk-off. So certainly a risk-off mood and a risk-off market, given the fact that we are now slamming into 1966, 1968 gap fill resistance. I think that's a wrap, folks. Be sure to visit cfds.com for your trading needs. Goodbye.